Most traders lose money not because the market deceives them, but because they deceive themselves at the very moment the truth is most visible. The great tragedy of modern speculation is the blind chase for breakouts, those glittering promises of instant profit that lure the crowd like moths to a flame. A trader sees price pierce a resistance level, volume surges, and his pulse races. He buys without hesitation, convinced he's witnessing the birth of a new trend. Yet, as Wyckoff would observe, what often looks like strength is merely the composite operator distributing his stock to the public. The trader rejoices for a moment, then watches in disbelief as the market reverses sharply, trapping him at the very top. The professional didn't lose money there. He made it, selling to the impatient. The lesson is timeless in the market. Movement is not always progress, and a breakout is not a buy signal. It is a test of your understanding. Ladies and gentlemen, traders and students of the market, welcome. Today, we address one of the most costly illusions in speculation, the breakout trap. For decades, I have watched the same scene unfold in every market cycle. Prices begin to rise, a level of resistance is tested again and again, and the public grows impatient. Then, one day, the price bursts above that line. Candles stretch upward, volume surges, and excitement fills the air. Traders rush in, convinced they've caught the beginning of a great trend. But soon, that surge fades, and the very same market that promised fortune now delivers punishment. This, my friends, is no accident. It is the law of supply and demand at work, orchestrated by those who understand how the market truly operates. The professionals, the composite operator. While the crowd celebrates the breakout, the professional quietly distributes his holdings into that very enthusiasm. The amateur buys, the expert sells. So tonight, we will uncover why most traders lose money on breakouts, how the smart money uses them as a tool of deception, and, most importantly, how you can read the footprints of supply and demand to avoid these traps and trade with the precision of a professional. Because in the world of trading, survival does not belong to the fastest or the boldest, but to those who understand the hidden motives behind every move. In the language of the markets, few traps are as deceptive and as costly as the false breakout. It is a move that preys not on ignorance, but on misplaced confidence. Traders believe they are seeing a moment of strength. What they are truly witnessing is the final act of distribution or accumulation by the professionals who understand the inner rhythm of price and volume. To the untrained eye, a breakout seems clear enough. The price breaks above resistance or below support and momentum builds. Candles expand, volume spikes, and every indicator seems to confirm the move. Retail traders rush in, eager to capture what they believe is the beginning of a new trend. Yet, moments later, the market reverses sharply. That breakout collapses back within the previous range, leaving the crowd trapped in losing positions. This, my friends, is the signature of the composite operator, the invisible hand that engineers false moves to transfer wealth from the impatient to the prepared. Richard Wyckoff taught that markets are not random. Every move reflects the eternal struggle between supply and demand, between the strong and the weak hands. False breakouts occur when demand appears to overwhelm supply, but in truth, the professionals are using the illusion of demand to sell their holdings to the public. The breakout is not genuine buying. It is a transfer. The public buys, the professionals distribute, and the result is an immediate collapse. Consider this example. Imagine a stock that has been moving sideways for several weeks between 95 and 100. Traders watch as it approaches 100 again and again, anticipating a powerful breakout. Finally, one morning, it bursts above 100, racing to 103 on heavy volume. The crowd piles in, social media lights up with excitement. Yet within hours, the price falters and slides back below 100, closing at 97. The breakout fails. Why? Because the smart money used the surge of enthusiasm to offload their inventory at premium prices. The crowd mistook professional selling for genuine buying. The key to surviving false breakouts lies not in emotion, but in observation. Watch the volume. Study the context. Was the move preceded by a period of accumulation or distribution? Did volume confirm genuine demand, or did it simply reflect panic buying? In Wyckoff's world, price without context is noise, but price with volume, structure, and logic tells the entire story. The wise trader learns to wait. He does not chase every breakout that flashes across his screen. Instead, he reads the market's intentions. A true breakout shows effort and result in harmony. Volume expands, price follows through, and previous resistance becomes solid support. A false breakout, however, shows effort without result, heavy volume with no progress, swift reversals, and sudden weakness after strength. In the end, the market is not your enemy, it is your teacher. Every false breakout is a lesson in patience, discipline, and interpretation. Once you learn to recognize the footprints of smart money, you'll stop being the one caught in the trap and start trading on the side of those who set it. The Wyckoff Method Breakout Strategy is not about chasing price, it's about understanding intention. Richard D. Wyckoff, one of the earliest and most profound students of market behavior, taught that every movement in price reveals the motives of the market's great operators. The composite man. Where the public sees chaos, Wyckoff saw structure, purpose, and rhythm, and nowhere is that structure more misunderstood than in the concept of a breakout. In the Wyckoff method, a true breakout is not defined by a single candle piercing resistance or support. It is the culmination of a process, a carefully orchestrated sequence of accumulation or distribution that unfolds over time. Before price can legitimately mark up or mark down, cause must precede effect. This cause is built quietly, often during periods of apparent stagnation, as professionals absorb or unload stock from the emotional hands of the public. Let us break this down in Wyckoff's terms. 1. Accumulation phase. Here, the composite operator is buying from weak holders who have lost patience. Price moves sideways, and volume dries up as supply is absorbed. The average trader mistakes this for a dead market, but in truth it is preparation. The calm before the storm. 2. Markup and preliminary tests. As demand starts to dominate, price begins to rise. However, before a true breakout, the market will often perform tests. Shallow reactions designed to confirm that supply has indeed been removed. These are the footprints of professional intent. 3. Sign of strength. Soest. This is the first genuine surge that indicates that demand is now in control. Price expands, volume increases, and reactions become shallow. But even here, Wyckoff warns, do not confuse apparent strength with true strength. 4. Last point of support. ALPS. This is where the professionals take their final positions before the breakout. It is the point of least resistance, the moment when price dips slightly, volume contracts, and the market quietly prepares for expansion. 5. The breakout. Now, and only now, does the real breakout occur. It is not driven by emotion, but by the exhaustion of supply. The composite operator no longer needs to push the market upward. The lack of sellers allows price to rise naturally. This is the moment of alignment between effort of volume and result price movement. A true Wyckoff breakout. To trade the Wyckoff Method Breakout Strategy effectively, one must adopt the mindset of a detective rather than a gambler. The goal is not to predict the breakout, but to recognize when the groundwork has been laid for one. Look for structural harmony, accumulation, testing, a sign of strength, and a confirmed breakout supported by genuine demand. Wyckoff once wrote, "The tape tells the truth to those who can read it." This truth is simple yet profound. Breakouts are not born in chaos, they are born in preparation. When you understand how the composite operator builds a campaign, you stop trading the noise of breakout signals and start trading the story of supply and demand. In essence, the Wyckoff Method Breakout Strategy is about trading with the smart money, not against it. You wait, you observe, and you act only when the footprints of accumulation align with the path of least resistance. Because in Wyckoff's world, success is not found in chasing price. It is found in understanding who is moving it and why. In the grand theater of the stock market, the smart money trap is one of the most subtle yet devastating psychological games ever played. Richard Wyckoff taught that the market is not a battleground of random forces. It is a carefully constructed mechanism through which the informed minority, the professionals, transfers wealth from the uninformed majority, the public. The so-called smart money doesn't move with the crowd. It moves before the crowd, setting traps that exploit human emotion, impatience, and ignorance of market law. A smart money trap occurs when institutional players deliberately create price movements designed to mislead retail traders. These movements often take the form of false breakouts, stop hunts, or shakeouts that appear to confirm a trend but are, in reality, the opposite. The professional operator understands that the average trader reacts emotionally. He buys strength and sells weakness. Thus, the smart money will manufacture both to manipulate perception. Imagine a stock trading in a tight range between $50 and $55. The crowd watches anxiously, waiting for a breakout above the 55 to signal the start of a new rally. One morning, the price suddenly surges to 57 on high volume. Social media lights up, traders rush in, and enthusiasm surges. But then, as quickly as it appeared, the strength vanishes. The stock reverses, slipping below 55 and tumbling back to 52. The crowd panics and sells. But who's buying those shares at 52? The same professionals who sold them at a 57. The public has been trapped. The smart money wins again. This isn't manipulation in the illegal sense. It's market logic in action. Wyckoff described this as the work of the composite operator, a single entity representing the collective actions of institutional players who move markets through planning, patience, and precision. These operators do not chase trends, they create them. They build positions during periods of fear and confusion, and they unload them during moments of euphoria. The smart money trap, therefore, is not random. It is the culmination of understanding human behavior at scale. To avoid falling into these traps, a trader must adopt the mindset of a professional observer rather than a participant in the crowd. This means studying volume, price structure, and context rather than reacting to headlines or social sentiment. In Wyckoff's framework, traps often occur during the distribution phase of a market cycle, when smart money is quietly selling into public demand, or during accumulation, when they shake out weak holders by driving prices temporarily lower. The antidote to the smart money trap lies in recognition and patience. When a move seems too obvious, too fast, or too exciting, that's your first warning. Real trends are born in silence, not in noise. True professionals wait for confirmation through tests, such as declining volume on pullbacks and the absence of selling pressure after breakouts. In Wyckoff's words, those who understand how the market operates will see opportunities where others see traps. The smart money trap is not an obstacle to fear. It is a map to study. Every trap reveals the intentions of the professionals and teaches us to trade with them, not against them. When you stop reacting like the crowd and start thinking like the composite operator, you no longer fall into the trap. You learn to set it. At the very foundation of all market movement lies a single, eternal law, the law of supply and demand. Richard D. Wyckoff built his entire methodology on this principle, calling it the invisible engine behind every price movement, every rally, and every collapse. It is not news, indicators, or predictions that move markets. It is the constant negotiation between buyers and sellers, between supply and demand. To master trading, one must learn not to predict the market, but to read this law as it unfolds in real time. When demand exceeds supply, prices rise. When supply overcomes demand, prices fall. Simple in theory, yet few truly grasp it in practice. Most traders rely on lagging tools, indicators that describe what has already happened, while ignoring the raw footprints of this law revealed through price and volume. Wyckoff taught that the market is like an open auction, with professional operators bidding and offering based on value and opportunity. Each bar on a chart is a conversation between these forces, telling us who currently holds control. Let's consider an example. Suppose a stock has been trading between 70 and 75 for several weeks. During this phase, volume begins to contract and price reactions become smaller. This is the absorption of supply. It indicates that selling pressure is diminishing and that strong hands are quietly taking positions. Suddenly, a large bullish candle appears, accompanied by a surge in volume that pushes price to the 77. This is not random, it's a sign of demand beginning to dominate. If subsequent pullbacks show lighter volume and shallower declines, Wyckoff would identify this as the testing of supply. The market is verifying that sellers are no longer strong enough to push price back down. Once confirmed, a breakout becomes not an act of hope, but a logical outcome of an imbalance in favor of demand. Conversely, when a market has risen for a long period and begins to show increasing volume with diminishing upward progress, that is the footprint of supply entering the market. Professionals are distributing their holdings while the public continues to buy, mistaking distribution for strength. Eventually, supply overwhelms demand, leading to a markdown. The classic end of a bull phase. Wyckoff's brilliance lay in transforming this invisible law into a visual map of market intent. His method doesn't chase indicators, it interprets behavior. By analyzing the relationship between price, spread, range of movement, and volumes, the trader can judge whether the result, the progress of price, is justified. If there is much effort with little result, it means supply is overcoming demand. If there is little effort with great result, demand is overpowering supply. Understanding this dynamic allows traders to anticipate, not react. You stop being surprised by reversals and start expecting them when the balance shifts. The goal is not to guess where price will go, but to see when conditions make a move inevitable. In Wyckoff's words, all the fluctuations in the market and in all the various stocks should be studied as if they were the result of one man's operations. That man, the composite operator, builds his campaigns on the law of supply and demand. Once you learn to see the market through his eyes, you no longer trade against him. You trade with him, guided by the timeless rhythm of the market's greatest law. Of all the costly errors committed by traders, few are as consistent or as emotionally charged as breakout trading mistakes. The allure is irresistible. A price surges through resistance, volume spikes, and every social media post screams, "Breakout confirmed." Yet, moments later, the market reverses, trapping traders in losses. This endless cycle of hope and disappointment isn't just bad luck. It's a failure to understand how markets, and the minds within them, truly operate. Richard D. Wyckoff warned against the dangers of reacting to the surface appearance of price action. The majority of breakout mistakes stem from confusing activity with intention. Most traders believe that a sudden price surge equals genuine demand, but Wyckoff taught that true demand reveals itself long before the breakout, in the quiet preparation phases of accumulation. When the average trader sees a breakout, the professional sees a distribution or testing point. This misunderstanding creates the perfect trap for the impatient and uninformed. Let's explore the most common breakout trading mistakes and how to avoid them through Wyckoff's lens. 1. Chasing the candle instead of reading the context. Most traders buy as soon as price pierces resistance, thinking they are confirming the move. In reality, by the time a breakout becomes visible, the smart money has already positioned itself. Wyckoff emphasized the need to study the cause behind every move. the structure that forms before the breakout. If there is no clear phase of accumulation zeros for uptrends or distribution for downtrends, then the breakout is likely to fail too. Ignoring volume behavior. Volume is the voice of the market. A breakout accompanied by excessive volume can often mean distribution, not demand. Professionals use the excitement of the crowd to unload their positions. Conversely, a true breakout usually shows balanced effort and result, steady volume with smooth, controlled price expansion. Always compare the breakout's volume to prior swings to detect whether it represents professional buying or emotional panic. 3. Trading without confirmation or testing. A genuine Wyckoff breakout is followed by a back up to the edge of the creek, a retest of the breakout level to confirm the absence of supply. Retail traders, however, jump in immediately and get shaken out when the test naturally occurs. Wyckoff traders wait for this test, understanding that markets often retest levels before beginning sustained trends. Patience, not aggression, is what separates winners from the crowd. 4. Letting emotion override logic. The excitement of a breakout triggers greed and fear of missing out. FOMO. This psychological trap leads traders to abandon their analysis in favor of impulse. Wyckoff often said, "The market will always test your emotional discipline before it rewards your technical skill." A disciplined trader follows the market structure, not the thrill of the moment. 5. Neglecting the market phase. Every breakout must be viewed within its broader market cycle: accumulation, markup, distribution, or markdown. Trading a breakout during distribution is a recipe for disaster. It's like swimming against the tide. The professional always aligns breakout trades with the dominant phase, ensuring that supply and demand confirm direction. The solution to all breakout trading mistakes lies in preparation and observation. The trader must transform from a participant to an interpreter, reading the story behind price action rather than reacting to it. As Wyckoff taught, the tape tells the truth, but only to those who learn its language. Breakouts are not invitations to trade, they are questions the market asks. Do you understand what's really happening here? The trader who answers correctly, by aligning with the law of cause and effect, supply and demand, and professional intent, no longer fears false moves. He trades with clarity, patience, and purpose. In the end, success in breakout trading is not about predicting price, it's about understanding preparation. The wise trader waits for confirmation, reads the footprints of the composite operator, and acts only when the path of least resistance is truly clear. That is how one avoids the traps, survives the noise, and trades like a professional in the timeless spirit of Wyckoff. Ladies and gentlemen, as we conclude this journey through the intricate world of breakouts, manipulation, and market logic, remember this: the market is not your enemy, it is your mirror. It reflects your patience, your discipline, and your understanding of how supply and demand truly function. Those who lose money on breakouts are not victims of bad luck, they are victims of misinterpretation. Richard D. Wyckoff devoted his life to unveiling the market's hidden order, a system governed not by chaos, but by intelligent design. Every false breakout, every sudden reversal, every emotional surge of the crowd is not random. It is engineered behavior, crafted by those who understand the market's natural law. The professionals, or the composite operator, do not chase price. They build campaigns. They buy when others fear, sell when others celebrate, and use the illusion of movement to transfer wealth from the impulsive to the prepared. Through our 5 lessons, we uncovered the deeper truth. The false breakouts remind us that what looks strong is often weak. Deception thrives where impatience lives. The Wyckoff Method Breakout Strategy teaches that real breakouts are born from cause and preparation, not from noise and excitement. The Smart Money Trap exposes how the professionals use psychology, not price, to control the market. The law of supply and demand reveals that price is merely an effect. Its true cause lies in the invisible balance between buying and selling power. We and breakout trading mistakes remind us that survival in the market is not about being right, it is about reading right. When we combine these truths, a new kind of trader emerges, one who no longer follows the crowd, but follows the footprints of smart money. This trader doesn't react to breakouts, he anticipates them. He doesn't fear false moves, he recognizes them as part of the professional's plan. He doesn't worship price, he studies behavior. Wyckoff once said, "The market is made up of human emotion reflected in prices." If you can read that emotion, if you can see beyond the candle and into the character of the move, you hold the same advantage as the professionals who shape the market's rhythm. So the next time you see a breakout pause, ask yourself who is buying, who is selling, and why, for in that question lies your edge. The market will always tempt, always test, and always teach, but only the disciplined student, guided by the timeless principles of Wyckoff, will turn those lessons into mastery. Trade with logic, trade with patience, trade with understanding. And remember, it's not the breakout that makes you money, it's knowing what comes before and after it.